Welcome back. So now we are going to talk about the wealth effect channel, which is about the, again we are going to talk about the monetary policy transmission, and I hope you are enjoying this course, the introduction to commercial banking and fintech. In this case, last session it was all about investment channels, and we saw that how Tobin's Q played an important role, and not only expanding the investment but also giving more credit availability. Now we'll be trying to understand the wealth effect side. So here again we are saying the same, that transmission sequence is same, that when rate of interest comes down, price of stocks, so people will be moving away from the banking system, investing in the stock market, and then as a result the stock market liquidity will go up, and then you will see wealth increasing, consumption increases, and aggregate demand increases. What is the purpose? That y is equal to a plus by plus I plus g plus x minus m, that here we are having, or you can see I wrote this particular donation notations, right? So maybe you can replace this with this and this with this. So I'm talking about this overall C is increasing because wealth has gone up. So if you are having, suppose earlier you were keeping in the bank was giving you 5% rate of interest. So if you have 1 crore rupees, you are having just 5 lakh rupees at the end of year. But if you are now getting into stock market, you are getting 20%. So if you have 20 lakh rupees extra, more than 15 lakhs coming as an absolute profit, more than what you are keeping in the bank, then this creates a good impact, right? So lower policy rates raise equity and housing prices. Higher household net wealth increases consumption via marginal propensity to consume. And mortgage equity withdrawal also will have the amplification, because this will also be people will be settling more of those kind of mortgage based settlement because they see appreciation in the wealth. So this is also one of the good reasons, right, we are getting into. So let's include the wealth component and marginal propensity to consume out of wealth. So here we have the net household wealth. So wealth, we are saying that it is the income, right? This is what is the households that we are getting, and this F that here we have, so this is related with the some inherited kind of wealth that you are getting, or so net household wealth is, suppose this is coming through some other channel, and this is what is the household wealth we are saying. And then we are also having the debt that you have borrowed money, so this is subtracted, right? And household wealth that we are saying, it is nothing but the price that we are saying of that house, and then what is the household wealth that here we have. You can think in two terms. Let me come back again. I think this explanation needs something. So let's start again. So I'm just saying that the wealth of the individual or the household, it depends upon the financial wealth plus the house if he owns the house. So this is what here he has, and the debt that he has borrowed. The house, the wealth that he has because of the house or real asset wealth, you can say fixed asset wealth, land and houses that you can see, it is related with what the price of house or the land he has and how much amount of land he has, right? So which means that WH can act as a collateral for the borrowing. So this particular person may attach this to borrow certain amount of money from the bank. Now consumption with wealth effect that we are seeing, so we can just take the partial derivative of this, and we want to see that how much is the change in consumption due to change in the financial wealth, how much is change in consumption due to change in the housing wealth that he has, lambda h. And if I just substitute that into the simple consumption function, so and do some kind of linearization process. So here we have C0 C1y plus delta lambda f wf lambda wh minus lambda d So lambda f is less than lambda h, right. So housing effect is greater, and it can also makes the collateral cheaper, and it will also allow the household to borrow more money. And as you know that if you have a more debt, more deductions from the wealth, and as a result your consumption comes down. So this we know already, right. So this let's go on. So what is the purpose here? Why are we introducing this part? Because this is related with the borrowing capacity of the individual. If the individual has the house and the house price is going up, then this individual, suppose it was able to borrow 80 lakhs, but now the house price has gone up, so now his borrowing capacity will also go up. So I am linking with that setup. Then housing wealth and investment channel. So what we are doing is that we are calculating the Tobin Q ratio household level. So price of house upon the replacement cost, right. So we can assign the same investment rule here. The investment rule that how much is the wear and tear in the house, plus if he has to go for the replacement or construction. So if QH is less than 1, right, so of course the slowdown or construction will be having a low. If it is greater than 1, it means that this individual is able to replace the existing house. So this is what build more and construction boom. So as a result, what you are seeing that your aggregate demand will shoot up, because you are seeing an increase in consumption due to WF and WH, and also you are seeing increase in investment if QH is greater than 1. If it is less than 1, then we are going to subtract, and this smoothness parameter phi will also have the impact on the same. So let's have the example. Suppose financial wealth is 30 lakhs, housing wealth is 70 lakhs, mortgage debt is 40 lakhs. So how much is the wealth of this guy total? Total coming out to be 60 lakhs, right. Now suppose stock went up by 10%. So now here you can see 3 lakh rupees he is getting. So because it has gone up by 10%. So in value terms it will be getting 10% of 30 lakh is 3 lakh. So this will be getting. House prices goes up by 8%. So 8% of 70 lakhs. So it is coming out to be 5.6 lakhs, right. And what are the parameters? So delta F is 0.03, delta H is 0.05, and this is what the consumption looks like, right. So this is what it implies here, right. So this is what we are mentioning it here, right. Now can we compute delta W, delta C and delta YD? So delta YD we can conclude easily that this particular guy, because of WF appreciation of 10% and 8%, he is getting 8.6 lakhs extra. How much we are seeing the consumption change? Consumption change we are seeing that lambda f, suppose it is coming out with 3%. So 3 lakh of that, so it is 0.09 lakh. Consumption change here 0.05, so it is 5.6, so it is 0.28 lakhs, right. How much is the consumption change? Consumption change is 0.37 lakh, right. So this is what it implies here, right. So here this is what it means. So here it shows about 0.37 lakhs. So 0.09 plus 0.28. So it was 0. We see how much change in consumption. So change in consumption, because we wanted to see this particular partial derivative, right. This we have mentioned here. If you want to see this partial derivative, how much we are. So we are seeing the increase in consumption of overall by 0.37 lakh, and this is also one of the important contributions of the wealth change that we are seeing because of the interest rate change in the economy. And now you can also substitute that with what I mentioned about the multiplier effect. So if C1 is coming out to be 0.6, the marginal percentage to consume, I think I mentioned it here. 0.6. So this is nothing but here we have marginal propensity to consume. So it is coming out to be 0.6. So this MPC that we mentioned, right. So MPC we know that 1 upon 1 minus MPC 1 upon 1 minus MPC, and MPC is nothing but C1 into delta C. So how much we are going to see? So 2.5. How much we are seeing in terms of aggregate demand because of this change? So this you can also see that we are seeing 0.925 lakhs, right? So a moderate wealth shock produces a magnified output response through the consumption. This is what we can conclude here. So overall, what it comes out, that if you want to see that because of the wealth change, if the depreciation, you can also go for comparative statics. Like for example, you can go by putting housing 6%, stock price 3%, and you can see how much we are seeing the increase or decrease, and then this will also further bring the case. In some cases, for example, in certain areas in Kerala and some other places, because of the demographic change, slow down, or maybe the fall in the fertility rate, we are seeing less number of people in those states. So housing prices are coming down. So that you can also put that as a comparative statics, and you can see. So in that case, it will be very difficult to have the impact of interest rate change, right? So this is what we are seeing. Now, if you want to understand the commercial banking channel, that how it impacts. So here we have the collateral valuation, that higher PH leads to more of the borrowing, mortgage collateral. Mortgage, it will household borrow against home equity, right? So this is what we have. So you can also put a house as a collateral and borrow money. So this is what it is done. Loan demand, higher wealth boosts the credit demand. Loan supply, lower or reduces the cost of funds. So overall, what is the major channel, that when the price of the house goes up, the loan to value ratio improves, right? For example, I had the collateral for a loan, I attached my house valuation was 1 crore. Now in next year it comes it goes up to 1.50 crore, then it makes more sense, right? So this is what. Lower default risk, more lending, and as a result we see a higher aggregate demand. So this is the macroeconomic setup that we see. So I hope this channel is helping you understand that how it is helping. Suppose I am putting one more case here, that there is a policy rate cut, mortgage rate fall from 9% to 7.5%, house price increase by 8%, right? Average home equity rises by rupees 6 lakhs per household. So bank side, how much we are seeing? The improved collateral values will have the less default risk, increase in expected credit losses. So reduce in expected credit losses, not increase. And SBI will report a lot of disbursement, right? And mortgage equivalent also, it will be bringing a lot of demand for renovations and consumer durables and those things. So overall, what it looks like, that macro effect goes in this direction, right? So this we have already discussed. Now we are getting into one more channel, which is related with what we call it as the asymmetric information, adverse selection, moral hazard. So when rate of interest comes down, price of a stock goes up and net wealth also goes up. So adverse selection comes down, moral hazard also comes down. So which means that when the rate of interest comes down, we are seeing price of the stock going up, and net worth of the individuals will go up, and as a result we see less of financial frictions, and lending will go up, investment will go up, aggregate demand will go up. But what happens when we have rate of interest increase? If you have the rate of interest increase, this leads to price of the stock coming down, because then you will have the individual depositing more money in the bank than investing in the stock market. As a result, this will go up, this will go up, and lending will come down, investment will also come down, and then aggregate demand will come down. But if the banks are the major source financer, then this channel may break. Right. For example, you take the example of Bangladesh, or maybe Pakistan, or maybe you think about Bhutan and Myanmar, all these countries where the stock market is all well developed. So price of stock will not have that much impact, even if your rate of interest increase or decrease. So those frictions you have to always keep in mind. So financial frictions, what do you see? So hidden information before contracting. You are buying a car, second-hand car, which is very famous example, and the car seller knows better than you. So and you end up buying a car which is not in a good condition, so then it is adverse selection for you. Moral hazard, you purchase an insurance for buying on your car, and then you are not taking care of that car, driving recklessly and then claiming, so that is also a big moral hazard case. Ex post and ex ante and ex post are two important conditions in this, right? So high net worth lead to better collateral, lower external financing premium, and this creates a lot of a good impact. So a stronger borrow incentive, and there will be lower agency cost. There will be a small KYC will be more than sufficient. The bank will not have to spend a lot of money on gathering details about you, because this is how it matters, right? So external financing premium, how it matters. So here we have, so your loan rate is nothing but a risk-free rate. So we often discuss in our family, right, why it happens that when we borrow money from the bank, they charge at a higher, they pay us or they give us the money at a higher rate as compared to when we deposit our money, we get the rate lower than the borrowing rate, right? Though it should be the same. What is the reason? So this is what your rate of lending by the bank, it depends upon the risk free rate plus the default premium that you are having, right? So loan upon the net worth, if the loan amount is greater than the net worth, then of course the risk is higher. And if the loan amount is lower than the net worth, then you know that the risk is lower, because it can be taken care of easily, right? So this is what we call it as the default risk premium, also external finance premium, which means that the company, the bank will have to spend a lot of money on screening on your applications and all, and those costs are added to your lending when you borrow money. So high net worth, larger collateral, lower default risk, and higher low upon net worth is the higher expected agency cost for lenders. Asset price movement shift the net worth and therefore the lending rate, and this captures what we call it as the financial accelerator, that how because of these frictions ultimately the borrowing and lending takes place. And this is very famous from Bernanke and all others have discussed this, that how it amplify the credit spreads and further the real activity in the economy, right? So let's understand one by one, right? So this is what we are trying to see. So when the interest rate is coming down, then your loan is going to come down, because your risk free rate is, or your reference rate is also coming down, right? So this is what it implies. What will be the balance sheet? That your reference policy rate or the risk free rate, let's for example keep that in mind. So price of stock is going to go up, net worth, and this we know that overall frictions are going to come down and your overall borrowing will cost will be coming down, right? But for the bank side, this reflect the liquidity premium, that why they go for charging the extra, because majority of the borrowers, what we call it as the limited commitment problem, they will have the limited commitment problem. They may not be able to convince, even by giving collateral to the bank, that they will be repaying back the money, right? And this becomes a major challenge when we discuss in detail about these things, right? So let's have the example, right? For example, if you have been K given as 100 crore, R is 15%, the before easing is 8%, net worth is 30 crore, after easing it is 7%, net worth has become 40 crore. So what is the loan that we are going to see? So here we have K minus NW, right? So this is what we have the so and 5x that we are considering 0.4, multiplier value that we are getting at 0.6, it is 2.5. Now can we compute L upon NW EFP and also the loan rate before and after easing? So this we can do it in this way. So L0 is 70, so your L0 upon NW0 is going to be 2.33. L1 upon NW1 is going to be 1.5, so which means that your net worth has gone up. As a result, your loan value is going to be cheaper. External financial premium that you are going to get, given the values of 2.33 and 1.5, so 0.04 we are assuming, and 0.404 in both periods. So this I have given it here, right? So it is for both periods, right? 0.04. So now if we are going to substitute this, so now we can see that it is coming out to be 9.33, and now you can see it is just 6%. So overall your loan rate is going to be lower, right? So this is what the loan rate will be, 8% without anything, and then 9.33 the external cost that we are going to see. So 17.33% bank was charging. After the rate decline of 1%, we are saying that it has come down to 13% only, right? And this is what so, and if suppose we have the project return of 15%, then this becomes more attractive, right? And here this is unviable kind of project, and this is viable project, right? So this is what it implies, right? So this is how we often deal with these cases, and this is what we often try to understand. So I hope this is helping you understand. And if you want to see overall aggregate effect, how much it is, so suppose investment is I0 is 0 and I1 it is 100 crore. So delta I is of course the 100 crore. So total aggregate demand, if you see in terms of financial accelerator, it is coming out to be 2.5 into 100. So it is going to be around 250 crore. So this is what we are seeing with regard to the, so K is the expenditure multiplier multiplied by the change in investment. So it is coming out to be around 250 crore. So this is what it implies. So overall what it says that when we have the rate of interest coming down, net worth increases, and this cuts loan rate, financial frictions eases, and this leads to credit expansion. Your investment expands and aggregate demand expands, right? This is what we have. So collateral valuation is that higher price of the stock leads to the net worth and better collateral, and these things you can easily understand. Now let's move to the one more example which is related with the corporate balance sheet. So if you have the policy rate 6.5%, it has come down to 5.75%. Equity is offering you 8%. The median net worth of the manufacturing firms are 12%. So SBI, suppose it reduces the lending rate and corporate term loan, and it will further boost it will reduce the loss given default and the probability default. And in most of the infrastructure sector, we find that it will be hovering around 15 to 20%, and overall channel that I discussed just now, it will be in this way, right? So this is how it implies here, right? So this is what it leads to. I also wanted to discuss one more channel which is related with the asymmetry in the credit market. What it implies, that it mentions about how the adverse selection and moral hazard play important role and how it can give a particular shape. In this particular session, this we have already covered, so let's not get into it. We will be touching upon a simple model of credit market and how it impacts the. So we are saying that suppose there are the number of good borrowers, and 1 minus A are the bad borrowers. Each borrower receives a loan of size L. The bank pays depositor R1 and changes the loan rate to R2. So pre-loan cash flows is how much? It is the good borrower. So bank receives, suppose R1 is the, so this is the loan rate. So this is the earning for the bank, and this is the deposit with the liability. So this is the amount that bank receives after lending, right? And bad borrower, so bank receives 0, only collateral later, right? So to depositor will be receiving 1 plus R1, L1 plus R1 and L1 plus R2. And if you write the profit function of this, so A are the good borrowers, so L into 1 plus R2 minus L 1 plus R1. So this is the good borrowers are paying to the bank, right? So good borrowers are paying to the bank. This is the depositors receiving money from the bank. So overall, if you just solve this out, when market clear zero profit condition, if I solve, so I get R2 is equal to 1 plus R1 upon A minus 1, and if I just simplify this further, right? So if A is 0, right? So if if A is 0, it means that all are bad borrowers, then you can see that it will be a completely different case. But if A is equal to 1, so what is the meaning? So 1 plus R1, so you can say R2 plus 1 is equal to 1 plus R1A. So if A is equal to 1, it means that all good borrowers, right, then your R2 is equal to R1, because 1 gets cancelled. Now you can see that why we pay premium, because we don't have all as a good borrower. We have a good and bad borrower both. When we have a more bad borrowers than the good borrower, so if you have A less than 1 minus A, then we have more premium charged by the banks. And if A is greater than 1 minus A, then even if the banks are charging premium, then you are paying just because of the regulatory change. Normally in this case, your borrowing cost is going to be cheaper. Why? Because this particular part is going to be lower, right? So this is a financial frictions are going to be lower. As a result, your overall borrowing cost will. So this is the ideal situation. When R2 is equal to R1, then we don't see default in the banking system, and your borrowing and lending rate both will be the same. But if you are more of if this R2 is not equal to R1, it means that A is either greater than or less than 1 minus A, right? So this is the situation that we often get in real life. We have also given you examples that if R1 is 5% and R2 is 12%, so this is what we get. So how much is the good borrower share? So you can easily get 0.93 are the good borrower, and spread narrows to 9%, so it comes out to be 9.6. So lower spread, better average quality, it means that more number of good borrower, and this has a lot of good impact on the overall economy. Similarly, I have also given you for the collateralized and borrowing. So in that case, you can assume that if you have house value of 80 lakh and haircut parameter is 0.6, right? So initial loan amount is how much? It is 48 lakhs. Suppose high house prices goes by 10% up, so now it is going to be around 52.8 lakhs, right? So which means that, so asset price collateral, it also helps it helps you in your borrowing, and it creates a good impact on the borrower side, right? So this is what we get. I have also given you example with regard to the collateral recovery and loan rate, and you can, given the values of R1 is equal to 6% and A is equal to 0.75 and lambda is equal to 0.3, you can get the expression. If you just substitute the value, it is going to be around 31.33%. And if there is no recovery benchmark, which is lambda is equal to 0, then we can see that your R2 at this when lambda is value is 0.3, it is 31.33. If lambda value is 0, then you know that your borrowing costs are going to be much higher, right? So better collateral, it leads to better recovery, and loan also has the better loan. I have also given you the example for the SBI and SME lending that you can always go through. It is linked with the same, right? So nothing much with this. I am stopping it here. So thank you. Thank you so much. Let me summarize what we have covered so far in 1 or 2 lines. That we were trying to understand the market dynamics and asymmetry, and we were trying to resolve the puzzle that why banks charge the higher rate of interest when they have when we borrow money from the bank, and when we deposit, then the bank pays us at the lowest rate. And this is partly because of the default risk premium, collateral, limited commitment, and also the asymmetric information and moral hazard, market frictions. So all these things are linked with the commercial banking. If you want to understand the micro dynamics, so this is how it is important. The last model that I discussed, it is from Williamson Macroeconomics. So if you want, you can refer that book. So with this, I am stopping it here. Thank you so much, and I appreciate your attention. Thanks a lot.